So the big question is, are we in a bear market? We're going to look through various charts, including patterns, indicators, breadth, and sentiment to find that answer. So in terms of assessing the damage, we always start with the pattern work. So let's go back to December 1st, because that was the last time we saw a successful bullish pattern play out. Now we know that was the biggest one as well. Market, or the S&P, hit 6,100 for the first time on December 6th. That completed what was an 11th month breakout. As we know, that came from a very substantial bullish pattern. But this was the 11th successful bullish pattern we had, or the 11th time we had a price target hit, all starting with the market coming back after the 2023 low here. So that means a successful bullish pattern has a few characteristics. Number one, of course, we need to see the formation take shape. We need to see a clean breakout. We need that breakout zone does not get violated. And eventually, seeing the upside target hit. Sometimes it happens relatively quickly. Sometimes it takes some time to play out. So another argument we had at that time in December, talking about what was going to come next, was that we didn't have a substantial target in place at the time because the market had gotten so consistent that we didn't have any previous volatility to key off of, meaning that the ranges weren't big enough. Just think about it. How did we get this type of upside target? It was because it was a measured move from the preceding volatility that was able to form and then fire off this breakout from a substantial pattern. So we had to wait for that to develop, which meant at some point we would have to get a change of character, see more volatility take place, and from that point observe if a bullish pattern could be formed. So that was a few steps ahead, but something to think about as 2024 ended and of course 2025 began. And since that point, we've had now 4 straight failed bullish patterns. So we went from 11 consecutive successful bullish patterns to now 4 consecutive failed bullish patterns. So we're going to go through these in chronological order and based on when their breakouts happened. And so at the time when 6,100 was in play, we did have 2 other upside targets, but not too far away. And so the smallest pattern came from this breakout, which was from this 4-week inverse head and shoulders pattern. It had a modest breakout target of 6,200. We say modest because you can tell from this point the measured move really wasn't that high. And so, like always, we had to see if this breakout was going to actually work, meaning that the breakout initially is always tentative until we see upside follow through, which we did for about a week. That faded, and right before the Fed's hawkish cut on December 18th, the pattern was negated. And of course, it was emphatically nullified after that occurred. And really, as we know now in hindsight, that decline of nearly 3% was led to a lot more volatility for much longer. And so at the time, again, a small pattern being negated, not a big deal. That being said, it was the first one we've seen not work out in over a year. So checkbox in terms of having potential change of character. So that led us then to this falling wedge pattern, which saw a breakout right when the market was right around 6,000 or so. And that gave us a target of 6,290, so a little bit higher. And again, we gave it the benefit of the doubt in the initial stages because it came back down and tested that downward sloping trend line twice, held, but again, with no upside follow through and continuing to come back down, testing 6,000. It was also negated right after the market came off of its high. So that was now 2 straight bearish. So keeping track, that was now 2 straight failed bullish patterns. Now, at the same time, when this was being formed, right, a much bigger cup and handle pattern started to take shape as well. Again, few failed breakouts to 6,100 that just gave way to a more identifiable handle of this cup and handle pattern. So the breakout, again, lasting only 5 days, getting up to around 6,150, and then the bottom fell out. And this is where we are now as of Monday, March 10th. And then, of course, the bigger one. And we saw the breakout of 5650 back in September here of this cup and handle pattern, which again was formed from the volatility of the summer. This is the July-August decline, the comeback, higher low into September, and the breakout. Now, we could call this successful because we did see an immediate upside follow through, right? came close to being tested, did not, and then it got to 6,100, relatively close to the target at the beginning stages of December, and they got even closer, again, near 6,150 just 3 weeks ago. So, in terms of if we had traded this, it's probably close enough to at least take some profits. But I think the bigger picture is that a major breakout zone was violated, and that would have been important to note even if we got above 6,180, even at 6,200, realizing that one of the biggest formations that we had a breakout from now is no longer in play. So again, 4 straight bullish patterns negated at this point. And so 156.50 was sliced through on Monday, March 10th. It also gave us a successful bearish pattern. Now we're looking at this as an inverse cup and handle formation. We also could have called it head and shoulders pattern if this was going to be a shoulder. Regardless, it would have given us the same scenario where downside break would have produced a target of 56.50, which of course it has hit. That's very important as well, because the only other time, again, since October 2023, that we had a downside target from a pretty big bearish pattern take place was in August. And that happened like that. The market went right up right after that target was hit back on August 5th, that Monday. And so, from that point, there were 2 other failed bearish patterns, which we had talked about before, right? The one that formed from September to November, never got the downside break, the election spike from that point, and other potential bearish pattern. Recently had 2 days of follow through. That was negated soon thereafter. This one now has worked out. So again, change of character, failed bullish patterns, successful bearish patterns. The complete opposite of what we saw from October 2022 all the way through just this past February. So something we can't ignore, whether we call this a bear market or not. It tells us, and this will be a theme, there's bear market price action taking place right now. So in terms of live patterns, right now, we don't have any. We just mentioned that 56.50 was a key zone because it confirmed or gave us a successful bearish pattern and negated a bullish pattern. So as we can tell, with the market really going one way over the last 3 weeks, both sides at this point are waiting for the next pattern to form. And that only can happen after we see what the next reflexive up move looks like, which of course we're still waiting to see take place. So in terms of drawdowns, again, as of the close of March 10th, it was about 9.8%. So give or take, pretty close to a correction. And so it's the biggest down move or pullback since now the October period in 2023. So as we know, market turned on a dime after that. So if people were waiting for a correction or reason to get back in to the market after down 10%, this is a pretty good indication of what could happen. Now, we know it's not apples to apples because the one from August to October of 2023 happened over 3 months. This time, of course, it's happening in 3 weeks. So the speed of this unwind makes it look and feel a lot different than what happened back in the fall of 2023. And so we have to go back to 2022 to see something more severe. We could look at the entire peak to trough move here, which was almost 30%, as the entire move. But along the way, as we know, bear markets are jagged, right? And so from this angle, we have here at least 4 different downturns of at least 13%. So we're not close to what happened at this point before we saw some rallies. But as we know, those of course gave way to some pretty good bear market rallies. The timing of those turns, of course, is the most difficult thing to pinpoint. So we'll get into that as well. So in terms of sentiment, as we know, the CNN Fear and Greed Index has been at extreme fear for over 2 weeks, which is one of the longest streaks we've seen in terms of this measurement. And so we go back all the way to right near the lows in September, late September 2020, to get a reading below 15, which it was at again as of Monday, March 10th. So again, from this angle alone, that should suggest that a bounce is coming. But let's not forget, we have 2022 to look at, and we see how many times and how often this index was showing extreme fear. More often than not during a bear market. Surprise, surprise. So with this indicator and with others that we've talked about and we'll look at going forward, it's the same type of message where very short-term depressed at this point, which suggests that whenever the bounce comes is going to be substantial, but just understanding that getting to this point even of extreme fear or being oversold raises some concerns that the tide has turned and we could see something like we saw in 2022 or other bear markets in history. So one of the things, of course, that we all know about is that the S&P now is trading below its 200-day moving average. And the saying goes, nothing good happens underneath the 200-day line. And so we can see how that is. This goes back to 2021, when the S&P first undercut that. The beginning stages of 2022 kind of oscillated around it for a few months before completely rolling over. And so what was once really not even a factor, right, for most of the comeback from COVID through 2021, then became resistance, which the market really didn't get fully above until first, second quarter of 2023. So similar to 2021, the S&P was at its greatest distance above the 200-day moving average, back in July, right before that summer swoon occurred. Going back to 2021, it kind of peaked in the beginning stages of 2021 and then continued to float higher until momentum started to fade. So we could get another rally that's strong enough to put it back above the 200-day moving average, but it's just about what the market does with it at that time. Whenever we get a rally, there's going to be a real necessity to see the ensuing pullback now create a higher low, which was really not the case at all, as we can tell, during the 2022 decline. So from a very short-term basis, we can also use a short-term moving average. 5-day moving average, Brian Shannon of Alpha Trends talks about this a lot, and rightly so, because a lot of the time, the 5-day moving average doesn't really come into play, because as we can tell here, even during these uptrending periods, it kind of oscillated around it more often than not. But when you have distinct downside action, this is what can develop, where really since the top in February, it's spending very little time above the line, only closing above it a single day, and that was completely wasted the next day. So at the very least, we have to see the S&P get back above that line. And does that guarantee that there's going to be a substantial follow through to the upside when that occurs? No, but that needs to take place to give the S&P a chance to actually capitalize on some momentum. And we can see how that happened from July to August. We had a few head fakes. Then as August began, still stayed below the line, and it took a few days of upside follow through to finally get it above. So using this strategy will never allow us to nail the low, but trying to nail the low over the last 2 weeks has been a losing proposition. Waiting for, say, 1 or 2 days above it put us in a good spot and let us catch the majority of that move to the end of the month and really toward the end of the year at that point. So that's really step one from this stage. So we have oversold in quotes here because we're talking about the 14-day RSI. And so this is the first time that the RSI has been below 30 officially, right, since, again, the October 2023 low. But as we have profiled here, these are all of the lowest readings that we've seen in the 14-day RSI going back to 2021. So we can spend some time looking at this, but one thing is clear, is that whether it was a bounce or a substantial trading low, the risk reward was actually favorable anytime you first dropped into an oversold reading. Now, a lot of these did not mark the low of the move, but as we can tell, soon thereafter, we did get a bounce. Even in 2022, some of them, again, short-lived, but in terms of pressing the issue on shorts or selling after the market gets oversold, it didn't lead to too much more downside, again, for that particular down leg, right? So we'll see if that happens again. It's not about suggesting this is going to be the low. It's wondering when the next real bounce is going to come from. And at that point, we can judge to see how it looks and feels at the time. Now, one of the bigger concerns is with the weekly Bollinger Bands. We've brought this one up before as a pretty good guide of keeping us in the trend for so long. Because as we can tell here, right, the weekly Bollinger Bands routinely have been touching the upper line all on the way. It's not just these past 2 years. We saw it in 2020, 21. We saw it at the end of 2019. We saw all the way through 2017, right? Repeatedly hitting the upper line is a bullish sign. On the downside, first time we saw the S&P hit the lower band in early 2022 told us that there was a change of character, and that continued, as we know, all the way in through the early stages of 2023, where not only did the S&P continuously touch the lower band, the ensuing rallies were not strong enough to get back to the upper band, which showed that momentum was consistently negative really until the beginning of 2023. So after that, after the low of 2023, as we can tell, the S&P only touched the lower line twice. Last time being last October 2023, and both of those times led to immediate upside follow through with months of positive action to follow. So those are good buy signals. So now, for the first time, again, since October 2023, the S&P is now below the lower Bollinger Band. The question is this another indication that we're oversold enough to rally and get right back up to new highs, or is it an indication that we're rolling over very similar to what happened at the beginning of 2022? And we're going to know on the next rebound, a theme now we've been talking about for this entire video. So in terms of breadth, a few ways to look at this. Number one, looking at the number of S&P 500 stocks trading above their 250 and 20-day moving averages. And so as we can tell, based on the action again through Monday, these are not near extreme lows. Even though the S&P is down a good amount in a very short amount of time, it doesn't compare to these key trading lows that we've seen over the last 3 years. And the reason is because a lot of this, as we know by now, is being caused by the biggest names performing the worst, the most influential names. So the S&P is going to look a lot more like, say, the Mag 7 as opposed to the other sectors right now, where that was a complete difference from December when we had those 14 straight negative breath days to start December, and really all the non-growth areas materially underperforming the S&P 500 and, of course, the growth sectors as well. So the market itself held in there relatively okay, where so many other areas had shot way below the respective moving averages, especially the 50 and the 20. So now the reverse has been in place, where most of the other areas, or a good amount of them at least, are still trading above those moving averages, still away from extremes. So the question is, do all those other stocks have to catch down now to what tech has been doing? And if that continues, will that then make the tech sell-off even worse, before we actually get down there? And if that's the case, of course, that will affect the S&P 500 as well. An even more striking chart, in my opinion, is this one. This is looking at the S&P 100, right, OEX index, which is just the biggest 100 stocks. So not surprisingly, it looks pretty similar to the S&P, right, breaking through its January lows, breaking below its late November lows as well. But its cumulative advanced decline line through March 10th is not even below its former January highs, right? So if that were to be the case here, then this S&P 100 index would still be hovering near its highs. So it tells us that technology is having even bigger effect on this index, where the majority of the bigger names, again, the top 100 of the S&P's 500 altogether are holding relatively okay, meaning that they may have gotten hit on a percentage basis, but they haven't been dropping as persistently as the bigger growth names over the last 2 weeks. In fact, if we look at the top 20 names that are closest to their respective 52-week highs, only one of them is technology stock, where 7 are healthcare and 4 are financials, all of them being insurance. And so lastly, we can look at all of these charts and indicators, but we get a true sense of what's going on simply by looking at the daily price action, which we review every day for CappThesis clients here. And as we can tell, right after the market made a new high, things started to really change. We've had 6 straight 1% moves, 4 of them being declines. And now 7 out of the last 8 days have been 1% moves. That's a lot, of course. And started to see a lot more closes below the midpoint as well. Now, if you remember, we have 5 key traits for an uptrend and downtrend. So for a downtrend, it's successful bearish patterns that started to work. Failed bullish patterns, we just had 4 straight. A high number of 1% moves, of course, we just saw that. And then more 1% declines versus 1% gains. Of course, that's been happening now over the last 2 weeks. And 5th, high frequency of closes below the midpoint. So now 5 for 5 in terms of downtrend or bear market price action. So again, whether this results in a full-fledged extended bear market, we'll have to see, but we have all the tools here to track it on an ongoing basis, which of course we'll continue to do in the weeks ahead. That's it for today. Check out these videos and subscribe. I'll talk to you next time. Thank you.